In recent finance news, you've probably heard something about the Federal Reserve cutting interest rates. And this is news that you don't want to just put off or ignore because it can affect you. The Central Bank of the United States, also known as the Fed, is charged by Congress with maintaining the financial and economic stability of the country. It tries to keep the economy afloat by raising or lowering the rate of borrowing money, and it has a great influence on your wallet. But first of all, why does the Fed choose to lower or raise interest rates? Well, the logic goes like this. If the economy is slowing or merely looks like it is, the Federal Reserve will lower interest rates. This action incentivizes businesses to invest and hire more people, and it encourages consumers to spend more freely. This greatly propels and helps growth. But on the contrary, if it looks like the economy is growing too fast, the Fed might decide to raise interest rates. This causes consumers and employers to hit the brakes on their financial decisions. So whether the Fed raises or reduces the cost of money, it affects interest rates across the board. But one way or another, it is going to impact savers and borrowers. Now, officials on the rate setting committee, known as the Federal Open Market Committee, typically meet 8 times a year. Now, they look at a broad range of economic data, but they most notably take a look and pay attention to inflation and employment data. Now, this is not the first cut. The Fed recently cut rates in July for the first time in over a decade. And if you couldn't guess, that happened to be the time when there was the biggest economic crisis since the Great Depression. So borrowing costs were cut recently again in this month of September. They're worried about the global growth slowdown, manufacturing in the United States, and of course, the trade war with China. So here are 5 ways you can expect the Fed interest rate cuts to affect your wallet. Number 1, these rate cuts affect your credit card rates. Most credit cards have variable interest rates and they're tied to the prime rate. This is the rate that banks charge to their customers that have good credit, their preferred customers. But this rate is based off of the Fed's key tool, the federal funds rate. So when the Fed lowers or raises its benchmark interest rate, the prime rate will usually rise or fall with it. What the Federal Reserve does normally affect short-term interest rates, so this has a great profound effect on what people normally pay on credit cards. Now that prime rate has not moved yet in 2019. The Fed has been on hold with that. Number 2, the Fed affects savings and CD rates. So if you're a saver and you save your money, you will not benefit from these rate cuts. That's because when the Fed chooses to lower interest rates, banks will typically lower the APY or annual percentage yield on their consumer products, most notably a savings account. Even the highest yielding savings accounts such as Ally Bank and Marcus by Goldman Sachs in June 2019 chose to cut their APYs in anticipation for the rate cut in July. Now, savings accounts' annual percentage yields are not only affected by the Fed rate cuts, there's much broader conditions, but there's also competition in the space, so that could affect it as well. These high yield accounts are attempting to outpace the rate of inflation, so you're still in good hands even if it's lower just a bit. And CD yields generally do fall when the rate cuts interest rates, but broader macroeconomic conditions also have an influence on them, such as the 10-year Treasury yield. But individuals should focus on the inflation-adjusted rate return on CDs. For example, in the late 1970s, the yield of return on a CD was in the double digits. However, inflation was as well. That means consumers' actual earnings were much lower due to the erosion of their purchasing power. So if you're worried about a Fed rate cut affecting your CD return, you're going to want to lock down one right now. So if you're into CDs and you're into investing in them and you see some good CD rates, you're going to want to take them right now. Number 3. The Fed rate cut could affect mortgage rates. Now don't be too alarmed, this is a little complicated. Mortgage rates are not immediately affected by Fed rate cuts. Interest rates on home loans are more usually tied to the 10-year Treasury yield. This serves as a direct benchmark to the 30-year fixed mortgage rate. So if you look in the past when the Fed does adjust interest rates, mortgage rates have not always responded in parallel. For example, the Fed actually hiked rates 4 times in 2018, but mortgage rates continued to go down into late December. But even though the Fed has little direct control over mortgage rates, they both end up usually being affected by similar market forces. In fact, the 30-year mortgage rate has fallen more than a percentage point from last year. So the two are sort of a reflection based off the same concern. Officials are worried about a slowdown in global growth, they're worried about trade tensions, and there's been very low inflation rates recently. And markets in recent weeks have shared those same concerns. Yields on the 30-year Treasury note fell to a fresh all-time low. And on top of that, the 2-year and the 10-year curve inverted for the first time in August 14th since the Great Recession. If you don't remember, I did a video on that showing you 5 ways to prepare for a recession. The link will be in the description as well as one of these 2 corners if you're on desktop. But you shouldn't worry too much. It's more so long-term expectations that tend to affect mortgage rates, not the short term. So if you have a mortgage right now, you might want to refinance because mortgage rates are looking like they'll continue to drop. Even if a reduction of 1/4 percentage point happens, this might shave off hundreds of dollars off your monthly mortgage payment. Number 4, the Fed rate cuts affect HELOCs. So if you have a mortgage with a variable rate or a home equity line of credit, also known as a HELOC, you will feel more influence from the Fed. Interest rates on HELOCs are usually pegged to the prime rate, meaning those rates will fall if the Fed continues to lower borrowing costs. But even large Fed moves aren't going to have a drastic change on HELOCs. Leading up to the Fed rate cut, HELOCs were still 2 percentage points higher than they were a year ago. Number 5, the Fed drives auto loan rates as well. So if you're thinking about buying a car, you might see some relief on your auto loan. Even though the Fed funds rate is a short-term rate, it's still directly tied to the prime rate. Auto loans are tied to the prime rate. But if you're buying a car, luckily for you, this might have a modest impact. The average rate on a 5-year new car loan is 4.62%. This is down from 4.72% before the Fed cut rates in July. The bottom line is that when the Fed cuts rates, it's reducing the cost of money. It incentivizes borrowing and disincentivizes savings. Essentially, it gets money out of bank accounts and into the economy. On the other hand, a Fed rate hike discourages borrowing as it increases the cost of money. But that doesn't mean it's a bad time to save. Having an emergency fund and saving money anyways is a prudent financial step. Good savings habits are important regardless of whether the rates are up and down. If the transmission in your car breaks, it doesn't realize whether rates are low or high. You don't want to stay ahead of the Fed's rate cut moves by checking in on your bank's APY. Check regularly. This will help you determine if your bank is generating a good rate that's competitive with the market. If it looks like the Fed is going to hike rates, you're going to want to pay off any high interest debt. This will help you create some breathing room in your budget before that Fed rate hike. The Fed cutting interest rates could have an effect on your wallet in many different ways, some more impactful than others, but you're just going to keep an eye on things, keep it on top of your finances as per usual. And I hope you enjoyed that video. I hope you got value out of it. If you did, be sure to smash that like button. It just helps with the algorithms that way more people can see videos just like this. And if you haven't already, be sure to subscribe to my channel. I post videos just like this every single week for you to enjoy. And if you'd like to get notified every time I post a new one, be sure to hit that little notification bell as well, so that way you're notified every time I upload a new video. See you in the next one.